Fundamental review of the trading book. Basel IV is the latest iteration of the Basel Accords, which are international banking regulations aimed at ensuring financial stability. FRTB stands for Fundamental Review of the Trading Book, a set of regulations developed by the Basel Committee on Banking Supervision to address shortcomings in the existing trading book framework. Objectives of Basel IV FRTB. Harmonization of global market risks. One of the primary goals of Basel IV FRTB is to create a more consistent approach to assessing market risks across different jurisdictions. By harmonizing the treatment of market risks, regulators aim to enhance transparency and comparability in capital requirements for trading books globally. Addressing undercapitalized trading book exposure, Basel IV FRTB seeks to ensure that banks hold adequate capital to cover the risks associated with their trading activities. This includes addressing any potential gaps or weaknesses in the existing regulatory framework that may have led to undercapitalization of trading book exposures in the past. Reducing regulatory arbitrage. Regulatory arbitrage occurs when banks exploit differences in regulatory treatment to gain a competitive advantage or reduce capital requirements. Basel IV FRTB aims to minimize such opportunities by revising the boundary between banking and trading books and implementing consistent capital requirements across both portfolios. Enhancing financial stability. Ultimately, the overarching objective of Basel IV FRTB is to strengthen the resilience of the financial system to market risks. By ensuring that banks maintain sufficient capital buffers and adopt robust risk management practices, regulators aim to reduce the likelihood of systemic crises and promote stability in financial markets. Key features of FRTB. Revised trading book and banking book boundary. Basel IV FRTB introduces changes to the classification of assets between trading and banking books, aiming to better align regulatory capital requirements with the risks inherent in each portfolio. Updated approaches for calculating market risk capital. The framework introduces the new standardized approach and the new internal models approach for calculating market risk capital. These approaches aim to provide more accurate and risk-sensitive measures of capital adequacy, reflecting the specific characteristics of each bank's trading activities. Transition to expected shortfall. FRTB mandates a shift from value at risk to expected shortfall as the primary measure of risk for the internal models approach. ES captures the tail risk of extreme events more effectively, providing a more comprehensive assessment of market risk. Incorporation of illiquidity risk. The framework considers the risk of market or instrument illiquidity in the capital assessment process, reflecting the potential impact of liquidity constraints on a bank's trading positions. Desk-level approval system for internal models. FRTB introduces a desk-level approval process for the internal models approach, requiring each trading desk to meet specific criteria for model accuracy, risk management, and stress testing capabilities. Measures to minimize arbitrage opportunities. Basel IV FRTB includes provisions aimed at reducing opportunities for regulatory arbitrage between banking and trading books. By aligning regulatory treatment more closely with the underlying risks of each portfolio, regulators seek to discourage behavior that could undermine financial stability. Internal models approach. Approval criteria. Banks must demonstrate the soundness of their risk management systems, accuracy of risk measurement, track record in stress testing, and proficiency in using sophisticated risk models to qualify for the internal models approach. Independent risk control. Banks are required to establish independent risk control units responsible for designing and implementing risk models, conducting regular backtesting, and providing oversight of trading desk activities. Senior management oversight. Senior management is responsible for reviewing daily and monthly risk reports, with the authority to enforce risk reduction measures or capital increases as necessary to maintain prudent risk levels. Tail risk modeling. Uniform methodology. FRTB promotes the adoption of consistent and robust techniques for modeling tail risks across banks. By ensuring that banks use standardized methodologies to identify and manage extreme events, regulators aim to enhance the resilience of the financial system to systemic shocks. Overall impact. Strengthening regulatory framework. Basel IV FRTB represents a comprehensive overhaul of the regulatory framework governing market risk in trading books. By addressing weaknesses in the existing framework and introducing more risk-sensitive measures of capital adequacy, regulators aim to enhance the stability and resilience of the global financial system. Improving risk management practices. The framework encourages banks to adopt more sophisticated risk management practices, including the use of advanced risk models and stress testing techniques. By promoting sound risk management practices, regulators aim to reduce the likelihood of large-scale financial crises. Minimizing systemic risks. By aligning regulatory capital requirements more closely with the underlying risks of trading activities, Basel IV FRTB aims to reduce the systemic risks associated with market volatility and liquidity shocks. This, in turn, contributes to greater stability and confidence in financial markets. In summary, Basel IV FRTB represents a significant milestone in the ongoing efforts to strengthen the regulatory framework for market risk in the banking sector. By promoting greater consistency, transparency, and resilience, the framework aims to enhance the stability and soundness of the global financial system. Thank you for watching.